Hello, this is Blake with Financial Markets Language, going over the market activity that uncovered February 24th, 2023. Today we definitely got an action-packed day. The PCE, as I went over yesterday, the PCE was coming out today, both the core and the normal PCE, and it came out extremely hot, especially on the year over year. The month over month only came out at 0.6. Which was just a beat by zero point 0.1, but still more inflationary than the 0.5 expected, and much higher than the 0.3 that we got for the December reading. And remember, it's every report is the report of the previous month, since we don't know the current month until it's over. So this month was the January month, and a lot of other data points have also came out inflationary, but the PCE was definitely no exception in this. The year over year in the PCE came out at 5.4, which was higher than the previous month, which was 5.3. But the big miss that we had was in the core, which is arguably the more important metric. The previous month we got 4.4, and we were expected 4.4 again, but instead we got 4.7. And obviously with the month over month being 0.6, that annualized, if we continue at this rate, obviously, we're going to be in a much different ballpark. With 0.6 annualized coming in at 7.2. 7.2, we haven't seen the PCE, I believe, 5 months. I'll have the actual information up now. But yeah, was a horrific report, and definitely caused a lot of action within the market. We had a huge rise in the dollar. The dollar on the day went up 64 basis points, so 0.06 or 0.64%. Quite a move in the dollar, putting the dollar at 105.26. Definitely continues the dollar's march higher that we've been seeing in the last 2 weeks. And with this dollar move higher, we continue to see more of the same trends that we've been seeing for the last little while. Bond yields continue to go up. We saw the 10-year crossover 4, so now we're over 4% on the 10-year. Definitely was quite a move. And the 2-year continued to rise with it, as well as the 30-year, the 3-month. Definitely came in that it appears that the Fed will be hiking more, and that obviously caused bond investors to pull back on their investments, causing yields to go higher. Which makes total sense. And as I predicted in the last 2 videos ago, I was more than certain that a lot of the market was under anticipating what kind of rate hikes we were going to have upcoming. A lot of people were thinking that it was just going to be one more 25 basis point hike or 2 more 25 basis point hikes, but a lot of people clearly think that's not the argument. I don't think we're going back to 75 basis point hikes, but I wouldn't be, especially at this point, I wouldn't be shocked at all if we saw another 50 and a 50, going up, showing that the Fed needs to, continue the fight against inflation, and that they pulled back a little prematurely, which definitely will hurt the credibility of the Fed if they pick this route. But in the long term, I personally agree, and I believe the majority of people believe that this is the best route in order to save, inflation from spiraling out of control and having a Paul Volcker moment where we have to massively hike rates and completely kill the economy in order to get to some sort of, normalcy within inflation, which is something that no one is looking for. With the dollar moving higher, we saw also the same trends within commodities. Gold, silver, aluminum, copper, all down. Oil was, once again, another surpriser, went on a little bit of a raise, but wholesale gasoline RBOB is what we call it here in the United States, did have a slight tick down. Take in mind, crude WTI, West Texas International, was up about 1.41% on the day, where you had gasoline RBOB down about 0.7% on the day. So a little bit of divergence there, and every other commodity across the board was down. With this hot PCE that came out, in addition to the last few inflationary readings, I was definitely expecting the, more or less the averages of most stocks to be down more than they were. We saw about a 1.1% decline on the Dow, about a 1.4% decline on the S&P 500, and about 1.75% decline on the Nasdaq. Definitely, given the last few inflationary guides, and this one also giving more ammo to the fact that we need more consistent rate hikes and potentially the Fed to not dial back, but in fact pick up the pace from the recent dial back that they've had. I was definitely expecting a bigger pullback after the news broke, but in fact, you actually saw, near the end of the day, which the beginning and the end of every trading day tends to be the most amount of activity, and most of that activity tends to be institutional. The majority of institutional buys and sells will happen, 30 minutes between the market close and 30 minutes between the market open. So with that, you definitely saw on both sides more buying during those two times than a lot of people predicted. Right when the data came out at 8:30 Eastern, you saw a massive drop, and then the market opened. You saw a little bit of a glimp up, and then went back down. It kind of just traded neutral for more or less the whole day, and then at the end of the day, you saw another little bit of a tick up. Definitely shows a lot more optimism within traders, despite consistent bad inflationary news that most likely will point to a Fed hiking cycle that will continue and to be more aggressive than was previously thought. The other data that came out today was we had consumer spending coming out at 1.8%, much higher than the 1.4% expected, and obviously significantly higher than the previous month where we had a decline of negative 0.1%. This is just showing that, even though December is over and a lot of the holiday shopping was over, we even saw a continued increase in consumer spending. So definitely concerning from an inflationary perspective, and gave even more, ammo to the inflationary argument. But one thing that we did see that ticked down that helps, more or less inflation was we were predicting the personal income for this month to be up 1.2%. But instead we just saw 0.6%. This is more or less giving more and more argument to a lot of people that are saying that, this entire economy is more or less financed on debt. And with interest rates going up, you're having more and more of a consumer credit crisis of people taking on more debt, this debt becoming more expensive, and prices going up because people continue to spend with debt. They don't have the money, and if normal market circumstances could take place, this debt wouldn't be used to continue to prop up these prices. People would just pull back on their spending, and by pulling back on this spending, it would allow supply to continue to overtake demand and have this inflationary process stop. But unfortunately, it looks like you're having consumer spending continue to go up, beat expectations, but the consumer is not making more money. In fact, by the last report, the prediction was they were going to spend more than the increase in wages, but in fact we saw very little increase in wages and a very high uptick in spending. So that gives a lot of concern to a lot of people. The last two pieces of data that we had that came out today were the new home sales. They came out at 670,000. That was much higher than the 620,000 that was predicted. Not significantly, just 50,000 more. And then also more than the last month, which was 625,000. So definitely a bit of a tick up, and obviously new home sales are primarily bought by the more affluent consumers with more money. You don't typically have regular Jane and Joes going out and buying new construction, because as an investment at least, it's pretty much a money pit, at least for the first 5 years. Like, you're almost guaranteed if you buy new construction and sell it within the first 5 years that you will take a loss. Obviously there are exceptions. I mean, if you have a massive appreciating market, a crazy bull market within the real estate market, you could easily see, some profit there. But typically this is far from the case. But, obviously if you were to do this in recent times, just in like 2020, bought a new house, you could easily have sold that, a year or two later in 2021 or 2022 for significantly more money, as you saw the price of lumber and a lot of the building materials skyrocket in price. catapulting the price of other new construction, and also catapulting the whole, market, in addition to the lack of supply also catapulting the market. That was the biggest factor. But obviously in new construction, the bigger factor was just materials and labor costs that were spiraling out of control. Consumer sentiment was a little bit higher than expectations, but in general, many people don't read too much into this statistic, since a lot of it is regarded as pretty arbitrary. But it makes sense. I mean, if even though it is arbitrary, you saw spending significantly higher, which more or less means that consumers have confidence within the market and they're willing to spend more, especially given that wages didn't tick as nearly as high as was predicted. So you have consumers more or less confident, but is this a real confidence or a fake confidence? I think only time will tell, and 6 to 8 months from now we'll really see how real this confidence was. Tomorrow we're going to do a special Saturday show, since we have the big Berkshire Hathaway, obviously Warren Buffett going out and presenting. He's one of the few people that are able to present quarterly earnings on the weekends. Gets a special treatment, since he essentially runs the market. So I'll definitely be paying attention to that, give you a report on that, and then we'll be breaking down more or less what we're going to be doing in the market next week, and what the market has scheduled for big events, and what we're watching. Hope you enjoyed this video, and I look forward to seeing you back here soon.